The end of the financial year is fast approaching, and of course that means tax time. Now, most people won't think about their tax return until next financial year when they're retrospectively filling in all the details about what they can claim for the year just gone. But the problem with that is your opportunity to minimize your tax liability has passed. So this year, why not get ahead of the game and consider how you can use your superannuation to save your tax? Let me explain. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. If you are under the age of 65, you have the opportunity to make a tax deductible contribution to your superannuation. If you're between 65 and 75, you may still have this opportunity if you meet the work test. That is, you need to have worked at least 40 hours in a 30-day period throughout the financial year. And unfortunately, if you're over 75, then this window is closed. And the reason why you'd want to make this contribution to super is because it can reduce your tax liability and may even lead to you getting a tax refund. Let me give you an example of how this works. Let's say you earn $100,000 before tax per year and you have no other investment income and have no deductions. Throughout the year, you should have paid $25,717 in tax through your PAYG system. So when you lodge your tax return, you don't have any additional income to declare, you don't have any additional deductions to claim, and as a result, you will not owe anything to the tax office, nor will you receive a tax refund. The PAYG was spot on, so you're all square. In the same situation, let's assume you make a $10,000 tax deductible contribution to your super. In this instance, you still would have paid $25,717 in PAYG tax throughout the year, but now you have the $10,000 deduction to claim. As a result, the ATO will calculate that you've paid $25,717 in tax, but you only owe them $21,517. So as a result, you're going to get a refund of $4,200. Now, of course, everyone's tax calculation is different, and the amount of refund you get, or whether or not you get a refund, is going to depend on your personal situation. But what this basic illustration does show is that making a tax deductible contribution to your super is a beautiful thing. Not only will you save money in personal income tax, but when the money actually hits your superannuation account, it's going to be invested and you're going to start benefiting from compounding investment returns. But of course, like with everything, there are restrictions around these contributions and there are downsides that you do need to consider before making a contribution. So let's look at the restrictions first. As we already touched on earlier in the video, there are age restrictions that you need to consider before making a contribution to your super. In addition to these age restrictions, there's also contribution cap limits that you need to work within. A tax deductible contribution to your super will form part of your concessional contributions cap, and in the current financial year, there is a $25,000 cap limit on these types of contributions. Now, bear in mind that your employer 9.5% superannuation guaranteed contributions form part of this cap limit, and any salary sacrifice contributions you may have made also form part of this cap limit. So before making any contributions, it's best that you call up your superannuation fund and find out exactly how much has been contributed as a concessional contribution already in the current financial year. You'll also need to account for contributions which are still yet to come in from your employer before the 30th of June, because these are obviously going to apply to your cap limit as well. The best way to do this is to have a look at the timing of your previous contributions and the frequency, and then work out if there's likely to be any more contributions hit before the end of the financial year. This financial year is also the first year that you can use catch-up concessional contributions. So what this means is that from 1 July 2018, if you have any contribution limit left in your cap, so you haven't used all your cap limit, then you can bring that forward for up to 5 years. So for example, if you only made concessional contributions of $15,000 in the 2018-19 financial year, then in the 2019-20 financial year, you could contribute up to $35,000. This would be the $25,000 current cap limit plus the $10,000 of unused cap limit. This is only available if your super balance was less than $500,000 on the 30th of June of the previous financial year. Assuming that you're eligible to make the contribution and you have the cap limit in order to do it, there are still a few considerations that you need to take into account before making a contribution. Firstly, it's important to note that concessional contributions are taxed by your super fund at the super rate of 15%. So if you earn less than around $20,000, then it's probably not worthwhile you making these contributions because you basically pay no tax outside of super anyway. Really, when calculating the net tax benefit of these contributions, you get your marginal tax rate and you take the superannuation rate of 15%, and that gives you the net tax benefit. If you're fortunate to earn over $250,000, then you're also going to incur Division 293 tax. Now, basically what this is it's an additional 15% tax on any contribution that would otherwise take your income over that $250,000 limit. Now, although that effectively takes the superannuation tax rate up to 30%, it's still a lot better than the marginal tax rate at that level of income, which is 47% if you include Medicare levy. Once inside superannuation, you won't be able to access your fund until you meet a condition of release. Now, the most common condition of release is obviously preservation age. I'm not going to go into how this works in great detail, but if you were born after 1 July 1964, then your preservation age is age 60. There are also some limited circumstances in which you can access your super due to financial hardship and due to compassionate grounds, but these are not guaranteed. Also, before making any contribution, you should understand how your funds are invested within your superannuation fund. Now, I always tell people that they should treat their super with as much attention and as much intent as they do with the money in their own name. Because at the end of the day, your superannuation is your money for your retirement, and therefore you need to take an interest in it. So you have until the 30th of June to get your final contributions into super. But bear in mind, the contribution is counted in the financial year once it's been processed and actually allocated to your super fund, not the date at which you send the money. So bearing this in mind, it's best to send your contributions in prior to the 15th of June to allow for that processing time. Making a contribution is easy. All you need to do is contact your superannuation fund and ask for banking details to make a member voluntary contribution. Most super funds will let you do it via either BPay or EFT, and there'll be a reference number that you need to quote on your transaction so the money is allocated into your account. Once the contribution is in, you need to fill in a notice of intent to claim form, which can be found on the ATO website, and I'll make a link to that website in the description box below. What this form does is it basically notifies your superannuation fund that you intend to claim a tax deduction for that contribution that you made. Upon processing the form, your super fund will treat the member voluntary contribution as a concessional contribution, and they'll send you out with an acknowledgement of notice of intent. Now, this is basically a letter saying that you're eligible to claim a tax deduction, and if you use an accountant, your accountant's going to want to see this letter. And that's it. You've successfully made a contribution to super, had it allocated correctly, and are ready to claim your tax deduction. And by doing this, you're going to thank yourself twice. You're going to thank yourself once when your tax bill shrinks, and you're going to thank yourself again when you retire and your superannuation fund is looking juicy. But that's it for me, guys. Thanks a lot for watching. If you like this video, please give it a like button. Let me know in the comments section below if you're planning on using some contribution cap limits this financial year, and I'll see you guys in the next video.